Welcome to the daily update. This is being prepared Thursday, September 8th, where we'll look at the action in the market today and then see how things look for Friday, September 9th. And originally, I had not planned on doing a full-length video for today, but we're seeing some positive things develop in the charts. So I figured I would go through, examine all the charts, and then present that to you. Also, I just want to send my condolences to the nation of Great Britain in losing their longtime queen. And that's the roots of my background come from the United Kingdom. And so I've always had kind of an interest in that. But apparently the UK will be experiencing 10 days of mourning. I'm not quite sure what that means, but there'll be a lot of things that kind of put that at the forefront right now. So be aware of distractions. People may be really tuned into this. They may really watch this as things are continuing to go on in the background that can affect the US economy, as well as the stock market and some of the geopolitical events that we follow. All right, so let's go back and talk about what happened on Thursday. Right at the open, we had a gap lower. And the one thing that I neglected to mention in yesterday's video was the speech that Chair Powell was going to be giving. And the futures were holding up okay, but we just dropped right before the open and we had a gap lower. And it's almost like, okay, anytime he's going to talk now, we're gun shy. And so we better freak out because we know whatever he's going to say, we're not going to like. Well, he stated the same thing, but it didn't really affect the market as much this time. So we were able to rebound after the open all the way up to R1 at 4,010. So we got back above 4,000. But as news about the Queen was coming out, I'm not saying that's what caused this, but we started to hit upward resistance and then some selling came in. It took prices back down to the daily pivot at 39.58. And I thought, okay, are we going to go lower from here? Because we essentially filled the gap and then some from yesterday's close. But then buying actually came back in and took prices back positive, but we never did get back up to R1. Going into the close, we did almost get back up to the high for the session. So that's pretty positive. It was a roller coaster day that you'll see when I bring up the chart, but it ended up being positive overall. We were up 0.66%. Volume was actually above average. We're starting to see a pickup in volume. The technicals, they're still negative, but we're showing some signs of improvement, and that's the reason for doing the full-length video today. Of course, the markets are really fixated on the inflation, interest rates, and growth concerns, and that's really going to come out next week. We have CPI and PPI coming out. Those are especially the CPI, that's the big inflation report, and the markets are just going to completely fixate on that, and it could really push things either way if it's stronger or weaker than expected. The geopolitical concerns, again, we kind of throw what's going on in England into that mix, just not because it affects the markets, but because of a distraction that it could cause. Earnings are starting to lighten up a little bit, but they're still coming out. We're still going back and forth with the recession debate. And then the Fed speak that could come out. We had some from Chair Powell. So what are some comments? He gave a speech to the Cato Institute, and he pretty much said the same thing that he has been saying. Inflation is our biggest concern. We're going to keep tackling that. We're going to keep raising interest rates. And then we'll come back later, I'm just paraphrasing, and try to salvage the economy if we can. And that's really what we've been hearing all along. So it's like, okay, this is old news. We've heard this before. So the market went ahead and started going up. We want to keep asking. We've seen 2 days now after coming off of support. Is this for real? Is this only an oversold bounce that we're continuing to see? We pretty much have worked off that oversold condition now, and things are starting to turn back up. So our technicals are showing some improvement. The European Central Bank ended up raising rates 0.75 basis points or 0.75%. That was a little higher than some people have been hoping, but that did have an influence. Europe ended up being down. They were kind of hoping maybe for the lower increase of 50 basis points, but they went ahead with the 75 anyway. The S&P is just above resistance at 4,000. So we were battling with 3,900 after yesterday's session, or during yesterday's session. We were able to get slightly above 4,000 in today's session. Can that continue? Or are we just seeing some kind of a bounce after becoming oversold? We're still keeping our sector rotation and our positive setups, even though they're improving. They're still on hold for right now. And I'll show you those charts. The 10 to the 2, the 10 to the 5, those yield curves remain inverted. We have interest rates in the dollar tending to go in the opposite direction of stocks. So that's what I'm watching during the day. And it gets a little tricky when you see the S&P is up and the dollar's up. It's like, okay, what's going to give? Or if you see both of them down, what's going to give here? The relationships aren't as strong as they have been, but they're still something that we should probably watch. And they change all the time. Just because they're going in opposite directions now, that usually doesn't last for a long period of time. Sentiment is still leaning more towards the fearful side, but it's not extreme. Really, the only report that came out were jobless claims, and that comes out every week. And they fell to 222,000. And this is more than expected. This is part of the narrative that's saying, wait a minute, employment's doing well. We expected 246,000 people to file for first-time jobless claims, and 20,000 less than that, 24,000 less than that, ended up filing. Maybe the economy isn't as weak as we're thinking. Maybe we're not in a recession. When we go into a recession, employment usually suffers. I don't see it suffering right now. So that's kind of one mindset that's going on out there. Our trend is negative and it's weakening. With the 2 up days now, we're seeing the ADX start to drop. It's not below 20 yet, and the red line's still on top, but it's starting to weaken and falling below the moving average. I've switched our bias over to positive because we've had 2 up days now, and I've changed our momentum to mixed with a slight positive slant. Now, that could all change in Friday's session. If we really start gunning to the downside, we're still kind of on thin ice is what I'm seeing here. But there is some improvement that we're starting to see. Sentiment is still, it's more in the fear side of neutral right now. And here's the historical chart. The latest reading of the RIDEX bear bull ratio, it still has us just about in the middle. We're not spiking up, showing excessive fear, and we're not way at the bottom, showing excessive complacency. And the weekly sentiment report that comes out from the American Association of Individual Investors. Now, this is a few days old now, and they tend to react to what's happening, but they're back down to being extreme negative, which could be positive for the markets. When we get extreme readings like this, we use this in a contrary manner, and we're seeing another contrary reading. Looking at some Isabel Nut charts, this is actually might be a little bit more useful just to kind of get an idea of what we're entering into as far as our time period. It just says September is worse when things are bad than going into it. So if you take all the Septembers going back to 1950, the average is we're down 0.5% for the month. If we start above our 200-day moving average, which we did not, then we end up being positive. This is where we started, below our 200-day moving average, and then we end up being down 2.7% for the month. And then when the year to date is below 15, which it is, because we're even though we're improving, we're still down more than 15%. Then we end up being down 7.1% for September. So this is a dangerous time of year overall. Now, there are always exceptions to that, just because the statistics say that tends to be what happens, and it might be what does happen, but we still have to follow the charts that we see, knowing that these probabilities are in the background as well. Another thing is our equity positioning. With the recent weakness, we're showing that folks are getting out of stocks a little bit more, but they're not necessarily extreme currently. This is taking the tech sector and relative to the S&P 500, and it's a weekly chart. They're seeing some things here called a head and shoulders top, or over here you have the left shoulder, the head, and then the right shoulder, and they think, okay, here's a breakdown and we're just going to tank from here. Okay, fine. We can use that and just know that tech has been weak in 2022. It might be weaker in the future. So we can take that and put that into our background thought process. Another thing is the daily S&P going back to 1928. This is a log scale, where the arithmetic scale, it would show really bouncy charts. This just tries to make it so that you can see a long range of dates without it bouncing all over the place. And it just shows the recessions and the bottoms right in here. And you might want to pause this and look at it. It just goes back historically. The most recent one was when we bottomed in March of 2020. There was also a very short-term recession, and then we bounced up out of that. So this is more of a historical benefit rather than really telling us what's going on. This shows the percentage of stocks in the S&P above their 10-day moving average. Now, that's something that I don't really measure. That's a little too short term. And I look at the 50 and I look at the 200 and longer term moving averages. But this chart just shows that we've gone extreme negative as far as those stocks in the S&P 500 that are below their 10-day moving average. 10 days short term. This is part of the short term oversold condition that we've been seeing. And so are we just seeing a little bit of bounce from that after getting this extreme negative reading? All right. Then here is it. This chart is suggesting that there's a challenging period ahead for earnings revisions. As we're coming into September, the general tendency, the blue line, is for earnings revisions to go down. This, it's probably hard to see, but this kind of yellowish line here, we've been going up a little bit, but historically, will it have a tendency to go down as well? And that's what we're really focusing on ultimately with stock prices or earnings. You have to have the higher earnings to justify higher prices. If you don't, then lower prices are justified. This is the 60-40 equity bond portfolio. How's it been doing over the last 12 months in different areas? In the US, not so good. And Europe is pretty much the same. We've been declining overall. Where Japan, it's been holding up a little better, but they're having a lot of problems in Japan right now with kind of a different economic situation with their bonds. That's why their interest rates are so low. They have a lot of US bonds. They may have to sell those if things get really bad, which if they sell those bonds, that's going to push bond prices down and interest rates up, which could affect the US as well. But this just gives you an idea of how things have been performing over the last 12 months. This is also showing, and I think I showed this just recently, maybe in yesterday's video, it shows how mortgages have really been declining, and then it compares them to other years. And if you think about it, housing prices are going up, interest rates are going up, people are starting to not really apply for mortgages right now. Maybe they can't afford it. And so it's not a real surprise that we're seeing this decline. We had another update of the GDP Now. This is a forecasting tool from the Atlanta Fed, and it's just suggesting that we might go back into a positive GDP reading for the third quarter. Now, this could change, and as we get closer and closer to this actually happening, it can change very quickly, but this is just what they're seeing right now. Another thing is the deviations of earnings that are above or below the long-term growth trend. Over here on the right, where we were really going up, and that's the deviation from the growth trend of earnings. So we were getting far away from that. And then the tan area here, or the earnings deviation, this is what they project. And they're suggesting that earnings are going to continue to go down. And if that's true, then stocks will probably continue to go down as well. And that's the area that I've really been watching, is earnings and earnings revisions, just because of what I said about justifying stock prices. All right, in the daily session here, we had growth up 0.66%. The large caps, value was also up. Mid caps, we saw the growth really improve, as well as with the small caps. So we were green across the board. Because we had the up day, we're seeing the VIX decline on a closing basis, and the bar is starting to come down as well. The VIX of the VIX is also declining. Then we have the Ulcer Index. This measures fear, where it's starting to turn down a little bit as we've been bouncing recently. We're down 16.86% from the all-time high. And the equity put call ratio continues to fall as the S&P is showing some improvement. We may have topped out here, but we did not top out above 0.8. So that would not necessarily be a new signal being generated. And I'll show you the longer term chart of this later on. Actually, this is the longer term chart where it looks like we may have topped out and we're starting to come back down. This is a 5-period moving average of the equity put call ratio. Here are the pivot levels for Friday's session, if you want to make note of those. And here's the chart that I've been focusing on a lot. First, we can see at the bottom where we're slightly above average with our volume. This is the trend line that seems to have held. Even though we broke down below it a little bit earlier in the week, we were able to close back above that, and now we've been coming up to that level. But we have a 50-period moving average that we still have to get back to. We also are right about at a previous pivot level, which sometimes can act as either support or resistance. So yeah, the chart's looking better, but it's kind of hard to really see a conviction right now. At least that's the way I'm seeing it. Here are the monthly pivot points for September with the updated charts. The short-term fib levels, and again, this is short-term. We're going back to the high set in March to the low set in June. We were able to retrace more than 50% of that and then fall back. Well, now we're coming back up to the 38.2% retracement. So we do have some short-term overhead resistance that way. We're starting to break above the 50% retracement when you go from the June low up to the August high. So not as significant, but again, more short-term resistance. And this is positive that we were able to get back above this area. This is longer term. This is also showing in around the 40-19, 40-20 area. We still have some overhead resistance. So if we can really break above that and then close above that, that would really help some of our overhead resistance levels. Looking at the sectors, we had financial and healthcare. They were up the most. We did have a couple of areas down. Communication, which has suffered all year, as well as staples actually fell slightly. Here are the scooter scores showing how utilities, energy, healthcare, and staples are into the 90s as far as their technical analysis score. With communication, it actually dropped a little bit more. It was in the 9s. Now it's dropping down to the 8s. So we're not seeing a real participation with communication and technology and some of the areas that really produce growth. Here's the sectors showing how energy has been bouncing back. Utilities have been bouncing. And then all of the other sectors continue to be negative with communication in last place. Here are the indexes going back to the all-time high. And again, this chart really doesn't change on a daily basis other than the percentages that we've seen since the S&P hit its all-time high. Technical alerts, some positive, some negative. At first, the NASDAQ went below 11.7, then it got back above 11.8. Okay. The euro went below 100. Now that doesn't necessarily affect the British pound. Okay, I'm just trying to think of what's going on right now. Britain always has had their own currency, and so it's separate from the euro. And then the S&P was able to get above 4,000. We're seeing the energy sector. It actually made a BPI cross below 70, so energy might be starting to come down. The cyclicals, which tend to go up when the economy is looking a little bit better. It crossed above 50. And then the NYSE summation index crossed below 0. And that's seen as something of a negative. All right. So the mid caps still, even though they're not having a stellar score here, they continue to be scoring the best at 69.6, followed by the Dow at 66.3. S&P's in third place at 61.3. with the small caps at 33.4, and tailing in last place are the Qs at 30.8. Even though they're improving, they're still showing a pretty weak technical analysis chart overall. All right, let's look at what happened intraday. It was a real roller coaster day where we gapped lower right down here to the pivot. We fell down, came right back up. We were able to see some buying come in, take prices positive. We went all the way up to R1, which acted as resistance. And then we started to flow downward. And then right about here, this is about the time when I heard that the queen had passed away, but it was actually a little bit before that. Okay, so I'm not trying to say that this is what caused this. There was just some selling that came into the program, or the selling that came into the market that could have been program trading. And it took us all the way down to the pivot. Well, that level held, and then we bounced up off of that. We never did make it back to R1, but we had a nice little buy program going into the close, which brought us almost back to the high for the session. Our trend with the upward movements in the charts right now, our ADX continues to fall. It's still above 20, but it's negative and declining because the red line is on top. The Arun is showing a little bit of a decrease in selling, but also a decrease in buying, and it's pretty much flat from the previous day's reading. Breadth is showing some improvement, both based on price and volume. And our advanced decline ratio is also showing some improvement. The new highs, new lows, they're still negative, but starting to turn up slightly with the 5 period. They're still not really turning up that much. They're flattening out when we look at the 10 period. So under the surface, we're not seeing a lot of strength, at least yet. This helps a little bit with the accumulation distribution. We actually crossed above the moving average. So that's a little more positive. Looking at some short-term charts, I don't know what they did here. They didn't change anything, but they changed the date. So I thought I would include that for the decision point scorecard here. And then here are the shorter term moving averages. We're starting to come up into the underside of the 10, 20, 30, 40, 50, where we still have a ways to go, but that could potentially be positive. Here's our moving average tree. We're kind of looking at the 50 period. That's the green one here. That could be significant. If we go up to that level, it might act as resistance. If we can break through that, that could be quite positive. And then above that is the 20 period. We have a couple of 20 periods right there. But the thing to watch for, that I'm going to be watching for, is can we get up to this 50 period moving average, which is at about 40.25, which is also above a fib resistance level. Then stochastic RSI showing some improvement, as is the Williams percent R. The force index also showing some improvement. Swinland trading oscillator, we're seeing a nice little bounce based on price and volume. McClellan oscillator still below zero, but is showing some improvement. And our 20 period moving averages showing improvement, turning up with the 50 and with the 200. Stochastics starting to show some improvement short term, just coming up a little bit intermediate term, and starting to roll over positive with the longer term. Looking at some intermediate term charts, here's the 50, 60, 70, 80, 90, 100 rainbow, where we're kind of coming up into the middle of this, and it's all getting jumbled together right now. The Sean trend meter, a little bit of an improvement. PMO still declining overall, but turning up slightly based on price and volume. Our oscillators are still negative. We're looking at resistance or support levels and moving averages right now. That's kind of what's giving us some hope. And we do have a couple of our indicators that are switching over to positive. With the PMO study, this is improving, turning up with the buy signals, and also still declining, but not as fast with those that are above zero. Chaikin oscillator showing improvement. Chaikin money flow showing some improvement. Volume continues to pick up. And then the vortex, this is still pretty decidedly negative, but we did see the red line decline and the green line start to come up. Here's the summation index. It's continuing to fall, but could be slowing down because the McClellan oscillator is starting to show some improvement. Here's all of our oscillators. But yeah, some of them might be turning up a little bit, but they haven't crossed over positive yet. The BPI is still above 50 and advanced slightly. That's positive. Ease of movement is showing a little bit of improvement. Ultimate oscillator improving. Money flow index improving. Here's the 19-day exponential moving average of the advanced decline line. It's also showing some improvement, but it never did go extreme negative based on price. It did go extreme based on volume, but this is currently showing some improvement. The TTM squeeze, we're turning to the kind of the lighter red bars here, and that's more positive. So it's picking this up. Can we break above this anchored moving average, which goes back to the COVID low? Balance of power showing some improvement. The CMB composite index, this actually generated a signal yesterday when it crossed above this moving average. So this is showing some improvement as well. This is actually a buy signal according to this chart. I don't know, it's a little too aggressive for my taste, but some of you may like that. And the fact that we dropped pretty low with this index before turning back up, that kind of makes it more meaningful. Looking at our charts, Heikin Ashi starting to turn positive, but our Kegi is still negative, as is the Renko. But the 3-line break is starting to turn back more positive. So we're getting a mixed picture here. Nothing new with the point and figure chart, and it's still coming off of a high pole reversal right now, which is a negative signal. Our Elder Impulse continues to be neutral with the SPX and the SPY. This is why I did today's video, was this chart. We had been with the dots on top for quite a while with the SAR system. Well, we have a dot below. I was just going to do a daily brief until I saw this chart, because to me, yeah, this can whipsaw you and you might really see some big drawdowns if you rely on this. But I found this to be a pretty reliable indicator. And the fact that this turned over positive, now we could tank down here and get a dot on top of this after Friday session. But right now, anyway, it has turned back more positive. All right. The go, no go system, it's really hard to see this, but we're more of a pale purple now with the advances. So that's more of a neutral with a negative slant. And long term, we're just coming up into the underside of some of our longer term moving averages, but we're seeing an improvement with the 50, 150, and 200. Special K, no, it's not really showing any improvement yet. Where we're neutral with the diamonds, and here's the Dow, not really anything significant. We do have the 50 period well above where we're at right now. So we're going to have to see a pretty big move just to get back to that. The Qs remain neutral as well. And not, again, could be showing some improvement with a higher high and a higher low. All right. But we still have a lot of overhead resistance with the NASDAQ 100. As we've been going up, the Vixen has been declining. The NASDAQ, again, could we get back above this previous pivot level? We're kind of right below it right now, and we have the 50 period moving average above where we're at. This is more positive, the mid caps, and this is more why the mid caps are in first place in our technical analysis score. It was able to get back above its 50. And if you watch these videos all the time, this is what we were waiting for. Was this 50 period moving average going to hold before we dropped? Well, no, it didn't. Well, now we've come back. We came down to S1 and we bounced back up and we've regained the 50 period simple moving average. So that's more positive. But is the mid caps enough? We want to see the large caps, and even more than that, even the small caps. The mid caps are, again, they're in the middle. They're like the middle child. So sometimes the markets don't really focus on these as much, but this is positive nonetheless. Where the NASDAQ still has a ways to go to show some improvement. The mid caps here, I think I got those in the wrong order. In fact, yeah. Okay. I was going the wrong way with my little button thingy here. The Wilshire still has some overhead resistance at the 50 period moving average. Okay. The dollar, it was down a little bit, but it's still just in a screaming uptrend. And the S&P to the dollar, still a pretty strong inverse relationship. Gold was actually down 0.6%, where silver was up 0.18%, but still an overall downtrend for precious metals. Oil bounced up a little bit, up 1.95% and closed at 83.54. Where the S&P to oil, they still are having a tendency to go in the same direction right now, but it weakened a little bit in Thursday's session. Bonds, we're just not getting much here. We were actually down with the bond ETF on this chart, and we're still fighting below the COVID low with our world bond index. So we're not seeing a lot of support there. But stocks and bonds are still having a pretty strong tendency to go in the same direction. And then our yield curves, nothing has changed here. The 10 to the 5 is inverted, the 10 to the 2 is inverted, and we're keeping an eye on the 10 to the 3 month, which never has gone inverted. Tech sector to the 10-year, also a pretty strong inverse correlation. And we saw a little bit of an advance with interest rates in the longer term and a little bit of a decline with the 3-month. Our scenarios, and if you hear any noise in the background, that's my cat he wants to make his own YouTube videos these days. But just some improvements here with our scenarios. It bounced up a little bit more, and there's also some construction noise going on here. A little bit of an improvement with those stocks above their 50, as well as with the mid caps and the small caps. And the 10-day average of the S&P highs and lows also bouncing up a little bit right now. And looking at the broad measure of this, we're still negative overall when we measure the 5-day moving average of the highs minus the lows. And this is the one where we thought it might come back up. If it gets above 0.8, that's a new signal being generated. We did not get up to that level, and we've been coming down slightly. And here's the small cap index. It was up, but we'd like to see some more strength there. It did hit support at S1, but it has a long ways to go to get back to its 50-period moving average. And so the small caps continue to underperform the S&P, as shown by this chart. The red chart is declining, and it's not really giving a lot of support to the S&P right now. The S&P to the 10-year correlation is still pretty strongly inverted. And then here's our sector rotation. Not much of an improvement with the Qs. Discretionary is where we're seeing follow through improvement, and not really much improvement with the large cap growth ratio to the large cap value. And so a little bit with the large cap, we're just a little bit of an improvement maybe with the small caps here, but not really what we want to see. We want these lines to get back above the moving average and the moving average to start going up. And then the S&P to the 2-year yield also having a tendency to go in the opposite direction, which means we are now taking out the spike that we'd been working off of, and we've actually surpassed that slightly. Our staples down 0.25%. And so they turned down a little bit with the ratio comparing it to the S&P 500. So this third spike over here still looks viable, but we really want to see this drop and see the S&P go up if you're bullish on things. But it's still hanging in there. So what's our outlook then for Friday? The technicals are improving after hitting that support, that trend line right at about 3,900. That is turning out to be kind of a big deal. We have wholesale inventories coming out. That's really not all that big a deal. So there's virtually no economic reports coming out. We have the whole list of geopolitical events. I mentioned some of them already. We just want to be aware that the markets are completely fixated on inflation and interest rates. And yeah, while there's other news that's going on that may be interesting and may even impact you, we have to focus on the news that's related to the stock market itself. And I'm not trying to be misunderstanding or insensitive to other news that's going on, but the idea behind these videos is to help us with the stock market itself. All right, our scenarios, we still have to go with the down scenario, even though things are showing some improvement after holding that trend line. So that may resist you from actually doing anything with this down scenario because we're bouncing after being oversold and we held at that trend line. We can't really go with the positive yet. It's looking better, but can the bounce continue? We need to see more follow through, and we're not seeing some of the other things that really can support higher prices in the S&P. Our scenarios, although they're showing some improvement, they're still on hold for right now. Our technicals, yeah, they're getting better, but we haven't even got back to the 50-period moving average yet. And sideways, well, we are dropping a little bit with the ADX, but it's still above 20 and the red line's on top, so it is negative. So our conclusion then is the S&P is negative, but it is improving. Now that could all go away with one solid down day. But right now, after Thursday's close, things are showing some improvement. In the short term, things are improving after bouncing from being oversold. Intermediate term is still negative overall. The SAR is switching positive. But we need more indicators to switch over positive than what we've seen. And long term, as long as we're below that 200-day moving average, we continue to be negative. So thank you. Have a wonderful Friday. I will prepare a full-length video for Monday's session. I'll do that over the weekend, and I'll also be doing the weekly and intermarket analysis videos.